Hey everyone, welcome to Alpha Insights. I'm Morgan. Good to have you with us.
And I'm Adam. Nice to be here. And hey, if you have questions while you're listening, drop them at stockalpha.ai.
Okay, quick one to kick off. Cizzle just posted a walkthrough of its hydration factory, and honestly, it's the kind of thing small cap investors rarely get to see.
Yeah, it's like a behind-the-scenes tour you don't get from most beverage startups. So, what's actually in that plant?
Right. The facility is a 110,000 square foot Tetra Pak line setup in Aurora, Ontario. It runs 6 production lines across 1 liter, 500 milliliter, and 330 milliliter formats.
And with the 6th line now online, capacity ticks up to about 204 million units per year. That's a lot of cans and cartons.
Exactly. Also notable, when Cizzle bought Flowwater's co-manufacturing business late last year, the deal brought roughly $184 million in contracted manufacturing commitments from external brands, and about $130 million in tax loss carryforwards.
And 5 of those 6 lines are owned free and clear, which matters for how the economics flow through the company, instead of going out the door as a vendor margin.
The big picture here is strategic control versus the traditional asset-light route. Most big winners in functional beverages built themselves by outsourcing production. Monster, for example, focuses on formulas and brands and leaves production to third-party co-packers, which helps support operating margins around about 30%.
Right, but then Celsius, after it scaled, bought its longtime co-packer for $75,300,000 to lock in supply and speed. So there's precedent for brands to own plants when volume justifies it.
Cizzle basically flipped that script. It bought a much larger facility earlier in its life cycle and structured the factory so it generates revenue from day one through co-packing contracts instead of being a pure cost center.
Which honestly is a clever trade. You get control over scheduling and cost of goods, and you can say yes to a big retail order instead of being pushed down the priority list by bigger customers.
Now, there is a cost to that control. Factories are capital intensive. Cizzle carries financing commitments into late 2026 that investors should understand before sizing any position.
Yeah, the obligations are real, but there's an upside too. Before the acquisition, Flow was making CWENCH and earning the margin on every unit. Now, that margin stays inside Cizzle and compounds as volumes scale.
And we saw an early sign of that in the numbers. In the quarter after the factory came on, revenue hit $12.6 million, up 253% year over year. And they reported their first quarter of positive adjusted EBITDA.
The timing is hard to ignore. Production coming in, revenue ramping, and adjusted EBITDA turning positive. Not proof of a miracle, but it's the trajectory to watch in the back half of their fiscal year.
Distribution also matters. CWENCH is now on shelves in more than 6,600 locations across Canada, the United States, and Europe. They opened a U.S. mass channel door with a 109-store launch in Target earlier this year, and the Canadian Tire Gas Plus rollout pushed them into about 180 high-velocity convenience locations.
Which is important because owning the lines lets them meet those kinds of purchase orders without being shut out by bigger customers. And the third-party co-packing they signed helps absorb fixed costs as well.
So when we break this down, there are 3 structural levers at play. 1, having the factory gives them control over cost of goods and scheduling. 2, co-packing revenue helps cover fixed costs. And 3, tax loss carryforwards and contracted revenue smooth the near-term earnings picture.
And the risk side, you're taking on financing and operating complexity. Running a plant is a different business than running a brand.
Absolutely. Execution matters. The factory itself is the physical moat. Stainless steel, filling lines, the whole thing. But it only turns into value if they keep filling orders, keep signing co-pack contracts, and hold margins as volumes grow.
Which is a long way of saying, factories are impressive on camera, but they still need the business behind them.
Short version, the walkthrough video matters because it shows a tangible asset underpinning a fast-growth brand. The numbers suggest the strategy is starting to show up in results, but there are financing and execution risks to monitor.
Keep an eye on production utilization. How much of that contracted manufacturing revenue converts to cash, and whether distribution ramps continue through retailers like Target and Canadian Tire Gas Plus.
All right, quick recap of key takeaways.
Owning the factory gives Cizzle control and margin retention, but brings capital and operational obligations.
The factory already seems to be moving the needle. Revenue jumped and adjusted EBITDA turned positive. But execution through the rest of the year is the real test.
And third-party manufacturing contracts plus tax loss carryforwards provide some support. But investors should track cash flow and financing as the next clues.
Okay, that's our take. Remember, this is informational only. Analysts note the strategy and the risks, but this isn't personalized investment advice or a buy-or-sell recommendation.
Got questions? We'd love to hear from you. Head over to stockalpha.ai, where you can ask us anything, and we'll answer live. And while you're there, check out more market content.
Thanks for listening. We'll be watching how the market reacts today as trading is open, and we'll bring updates when there are new developments.
Talk soon. Thanks, everyone.